What is recasting a mortgage, and what are the pros and cons of that?
So recasting a mortgage. So, for example, let's say you got some money that came in, an inheritance or whatever it is, and so you've got this lump sum, and you've got a fixed mortgage, or
Hmm.
at least a fixed period. You can have 7 years fixed, and then it goes variable, or
Yeah.
whatever. It can be 30 years fixed, 15 years. So one of the problems with dumping a bunch of money into the mortgage is if you don't recast it, nothing really changes.
Yeah, you still have the same mortgage payment, but you
Yeah,
save interest because
right.
you'll pay off sooner.
Yeah, the big advantage of that is you put that chunk into your mortgage. It won't affect anything, it won't help anything today, okay? Because you're still going to have the same payment, but more of that payment's going to be going towards principal now because you've just reduced the principal. So you're going to pay it off faster, right? So eventually there's a pretty nice payoff. However, another way to do that, if you want to pay off today because you need to reduce your payment, let's say, for example.
Yeah, recasting is basically you put a lump sum into your mortgage, and then the loan provider will basically kind of re amortize based on the new principal amount. So like it'll keep the same loan terms, so your interest rate will stay the same, your due dates will stay the same. The only thing that changes is your monthly payment.
Yeah, so it's a nice way to go. You don't have to go through a whole refinance again,
Yeah, so
maybe pay fees or
you'll
whatever.
have some fees, but they
Right.
typically aren't too
Small.
expensive.
Yep.
You don't have to do any kind of credit checks. The loan term stays the same. Um, if you have PMI, you potentially could have enough of the equity that you don't need PMI anymore. So that could be a savings of that.
What's PMI?
Uh, private mortgage insurance.
Yeah. So, not everybody has that, but if you have, usually if you don't put down at least 20%,
Yeah,
you end
anything
up
below
with
20%. So
private mortgage
especially
insurance, which
for
can be expensive.
especially for younger owners, a lot of times they put 5-10% down
Right.
just to get in.
So let's say your lump sum is able to get you down to that 20% level or better, and it would get rid of that private mortgage insurance. So,
Yeah, some of the negatives is you're not changing the interest rate. So like if
right,
you have a good interest rate,
right.
if you're in the 3%, should you be putting the money into the mortgage? Because you're really locking up this money into your
Right.
home equity.
Right.
And the only way to get it back out is you sell the house or you have to take a home equity loan.
Yeah. Well, you,
So
you pay it off earlier, so you sort of get it off. I pay it off 12 to 36 months before I would have. I get my payback in
yeah,
that time frame, right at the very end of the loan.
that you won't have that with the recasting because
Right.
you keep the same terms.
Right.
So you only saving by having a lower outflow basically each month.
Yeah. Yeah. Exactly. So it's an interesting thing. You were telling me there's a minimum usually that these banks have. Not everybody will do it either. It depends
Yeah,
on your
so
loan.
yeah, you have to check with your loan provider.
Right.
There'll have to be some amount. Some say goes as low as 5,000, a lump sum of $5,000, and
Yeah.
they'll recast it. But I assume it has to also depend on your property value too, what you're
Yeah.
willing to do.
I would assume the banks are going to want to see more coming in to make the effort to do it. But nonetheless, it's an interesting thing. It's one thing to look at, especially if you happen to have a higher rate, and then now people have higher rates, that have
Yeah,
bought.
if you're in the 5-6%,
Right.
recasting is you get that you get your returns and essentially having a lower payment or each
Mhm.
month you have is that kind of return of that principal in a sense.
Yeah, theoretically, you could take a look at that and you might be making a pretty healthy return on that investment in terms of reduction of payment, at least from a cash flow standpoint, you get a lot back. So I could go buy a dividend paying stock that pays 7%, or I could dump that money into my mortgage and reduce my payment by the effectively 7%.
Hmm.
And, the dividend paying stock is is
It,
not a
it
bad
fluctuates. It fluctuates. It's
it's
not
not a
guaranteed.
bad solution, but it does have some disadvantage. It fluctuates. They could change the
Yeah.
dividends, right? You could lose 20% on the price and get 7% dividend and actually be under,
Yeah,
or it's more guaranteed in the mortgage. It's just the payoff is just different.
yeah, and recasting, if you keep that your old payment, let's just say, hey,
Right.
I'm going to keep doing my same old payment, you'd pay off that loan
Yep.
faster. It
Right.
also gives you a little flexibility too, saying 1 month, hey, I was stretched a little thin, I might be able to just do the minimum payment rather than
Yeah,
doing the old.
that's right. Gives you some wiggle room in case things go south financially for you for whatever reason. Okay.